Hi everyone. So today is our fourth lesson for strategic financial management, and we will be continuing the lesson that we started on last week. So we were actually talking about the sources of finance, and we spoke mostly about short-term finances. So first let me increase the size of the slide so that you guys can properly see what I'm sharing here. So, yeah, before talking about today's lesson, just a small recap of what we did. So first we spoke about short-term finance and we kind of covered all the sections. So we spoke about overdraft, short-term loan, trade credit, short-term operating finance, bills purchasing or even discounting. We spoke about factoring and invoice discounting, and we also spoke about indirect or non-funding sources. So we spoke basically about short-term finance, obviously the finance which is finance sources which is less than 1 year. So now we are moving on to long-term finance, and out of the long-term finance we also covered equity finance. We were talking about different aspects of equity finance, and today we will be covering debt finance and the remaining sections such as preference shares, long-term financial lease, the venture capitals, even grants, and so on. Now, moving on with debt finance. So now what is debt finance? So debt finance is basically a borrowing for which the company has to pay a fixed interest. So basically the company is liable to pay a particular amount of interest annually for a debt financing source. So this interest which is payable whether a company makes a profit or loss. So one of the differences while talking about equity finance, one of the differences that I told was that when it comes to equity finance, even though the company generally pays dividends, there is no, the company is not liable to pay an annual dividend to the company. Sorry, for the shareholders actually. So basically it depends on what the company decides upon. So if there is a loss, the company can probably not pay the shareholders. So the company has the discretion on how to handle their finances when it comes to the shareholders. However, when it comes to debt finances, the company is legally obliged to kind of pay that interest rate. Basically, it's an annual interest payment which is fixed. Sometimes in different cases, it could be variable. It could differ how it works. However, this payment, the company is legally obliged to do whether or not the company makes a profit. So that means if a company makes a loss, still the company has to find a way to pay them back. So that is something the company needs to look upon while choosing their source of finance. That's one of the reasons it's very important that the company choose the best mix of financing when it comes to the sources of finance. And another thing that we need to understand when it comes to debt finance, the debt finance is tax deductible. So what do we mean by being tax deductible? So what we mean by tax deductible is that when a company profit is calculated, so generally out of the profit that is calculated, there is a particular tax rate depending on the company, and then that particular tax amount is calculate that particular rate, whatever percentage is kind of calculated, and the tax is supposed to be paid. However, when a company has debt finances and they are supposed to pay back some kind of fixed interest, that particular payment can be reduced from the profit. So then it is not it's tax deductible actually. So because of that, the profit after when we calculate the tax, generally when we calculate the profit actually, after the profit, the interest is reduced, and therefore thereafter a profit after interest payment is calculated in order to understand how much tax is supposed to be calculated and paid to the tax authorities. Therefore, in one way, even though the organization has this legally obliged situation where they need to pay back the debt financing, the fixed interest, whatever the situation is, there is one of the advantages of having debt financing is that that particular interest rate will be tax deductible. Therefore, the company is, saving something out of it. So that is one of the reasons. I mean, a person would wonder, why does a company need to have debt finance? I mean, it's a lot of work. You need to pay the debt back and then pay the capital back. Why are you taking all that, all that extra work when you just can kind of maybe have more shareholders where there is less risk? I mean, actually more risk, but however, when it comes to paying back, the company doesn't have much to think about. So this is one of the reasons the debt financing is also considered. Therefore, it's very important for an organization to kind of think upon their mix of finance. So it's very important to kind of understand the different sources of finance and what is the most suited mix for that particular organization, because organization to organization, according to the operation, what they need could differ. So the source of understanding the sources of finance is very important for an organization in order to have the best mix suited for the organization when it comes to financing. So now we were talking about the debt financing being tax deductible actually. So if the company goes into liquidation, so what happens? So when a company goes into liquidation, what happens is, debt will be kind of paid before anything which is settled to equity holders. So while we were talking about equity, we said, yes, the equity holders' risk is high because they are the last to be kind of settled. Debt holders have lesser risk because they will be paid before anything else. During liquidation, they'll be paid first. And also in any situation, even if a company has a loss, the company has to find the ways and means to pay their debt holders back, right? So ranking of repayment of debt depends upon the kind of security the lender holds. So therefore, like the debt carrier has a lower risk compared to the equity. So when it comes to debt finances, there are different types of debt finance. So even if we talk about debenture, there are different types of debenture. So also, generally, when we talk about debt finance, there are different types. So here, because it's strategic financial management, I would have kind of explained to you more about different debt financing methods and categorizations in modules such as investment analysis. However, here, because we are talking about strategic financial management, we'll be talking upon the types of debt finances. There are main 5 types of debt finances, and we'll just kind of skim through to kind of understand that how different sources of finances are kind of selected upon. So as you can see here, there are 5 types of debt finances. The first is the loan stock or the debentures. Then would be the deep discount bonds or the zero coupon bonds. Thereafter, it would be the institutional debt and bank finance. Thereafter, euro bonds. And lastly, we'll be talking about convertible bonds and warrants. So now we will move towards each section and try to kind of get a small idea of what each source of finance is. So first, we are going to talk about loan stock or note. So now, what is a loan stock? Loan stock is basically like kind of like a written acknowledgement of a debt of a company, where normally this kind of contains provisions as to when the interest needs to be paid and different repayment terms for the principal. And when it comes to debentures, these are also kind of similar, but they're not. Now, when it comes to loan stock, they're generally backed by collaterals. However, when it comes to debentures, they're not backed by collateral, but reputation and the credit worthiness of a company. So they are mainly issued by large companies in order to raise their finance, and debentures are similar to bonds. However, their conditions and securitization differs, and in practice, the difference is not much notified, and sometimes it is identified as bonds. So even though I say loan stocks and debentures, loan stocks are a little different from debentures. So what is the difference that we identified? Loan stocks are generally, it's kind of a written acknowledgement, but it is backed by collaterals. However, when it's a debenture, it is backed by reputation or the credit worthiness of a company, right? So generally, so when it comes to debentures, governments or like large organizations are the ones who use this method to raise finance. Small companies will probably not use this particular type of financing method. Okay, so thereafter we will be talking about deep discount bonds. Now, what is deep discount bonds? These are basically bonds which are issued at a high or a deep discount and are generally deemed at a par value premium. So when it comes to deep discount bonds, what happens is these are bonds that are where the par value is kind of there is a particular par value, but then the value that the person buys the discount this bond would be less than the par value. Let's say if the par value is 100, what happens is the deep discount bond would be something like, let's say 60 rupees or something, or 60 pounds actually. So it would be something like 60 pounds, and so it would be kind of like redeemed at, so after that particular time period, it would be redeemed at a premium price, which could probably be 120 or 100. So those are the deep discount bonds. Now we will thereafter we'll be talking about zero coupon bonds. Now, what is zero coupon bonds? These are bonds which is with a higher capital gain or lower or zero interest in comparison to the deep discount bonds. So now these deep discount bonds and zero coupon bonds are quite similar actually. The difference is actually that these are both bonds. They both have like deep discount, obviously. So it is, bought at a amount which is way less than the par value at a premium. However, bonds with these have a higher capital gain and a lower or zero interest rate. So these are the zero coupon bonds. Now, when it comes to investors, they will not get any inflows before maturity if they require cash. They will have to sell the bond at a ruling market price. So let's say I'm a person who has a zero coupon bond. If that is so, I will not be able to, go and give it to the person who issued it or the company who issued it and then get back the money. What the zero discount coupon holder has to do is the holder will have to sell it to another investor in the ruling market price. So those are zero coupon bonds. Thereafter, it's the institutional debt and bank finance. So these are basically the bank loans that we all know about, where banks and financial institutions give kind of loans based on collaterals and kind of different agreements with like an interest that needs to be paid annually or monthly. And thereafter, where the capital repayment plus the interest is kind of included in that monthly repayment. Thereafter, we will be talking about Euro bonds. Now, what is Euro bond? These are bonds which is not that. One of the things I always start while we talk about Euro bonds. This is not a bond which is actually done sold in Europe just because it says Euro bond. That is one of the things I always start with, because of the name, people tend to think it's something to do with Europe, which is not. So these are basically bonds which are denominated in a foreign currency, different from the country in which they are kind of issued. So this is Euro bonds help an organization to kind of like do their work using a different currency, or like show, kind of have bonds which will be sold in a different currency actually. So basically when it comes to Euro bonds, they are outside the control of the company, the country actually in which the currency they are denominated. So another kind of debt financing method is the convertible bonds or the warrants. So when it comes to convertible bonds, they are like the bonds that we know, where fixed interest debt, like a debt security which has a fixed interest rate and which the holder can kind of choose to convert into ordinary shares of company at a predetermined way and at a predetermined date. So here, these bonds are convertible at a fixed interest rate, and they are convertible towards what? Ordinary shares. But for these, there is a predetermined rate as well as a predetermined date. So when it comes to convertible warrants, it gives the holder the right to subscribe to a future date for a certain number of ordinary shares at a predetermined price. So that's the difference between the bond and the warrant. Now we were talking about debt. So because we were talking about debts before here, we were talking about different types of debts. I will just be doing a small introduction on how to calculate certain types of debts, or how the cost of debt can be calculated while we are preparing for a learning about sources of finance. So first, I will be talking about cost of irredeemable debt. So now, what is irredeemable debt? So these are basically debt that contains no stipulated date of repayment, or it's basically done for perpetuity. So the interest payment is assumed to continue in perpetuity. So these are debts for which an organization does not need to repay the debt amount that they invested on. Like, let's say the capital amount, they don't have to pay, they have to just continue paying the interest payment. So there is no capital gain here. And because of that, the interest element is kind of calculated. So when we're calculating the cost of irredeemable debt, the cost of debt is generally the interest rate payable divided by the market value of the bond or the loan note, excluding the interest. So interest rate payable. So the cost of debt is generally considered as KD, and the interest rate payable is I capital I, while the market value of the bond is MV. So KD equals in I divided by MV. Now, when we were talking about debt, what was the main thing I spoke? Like, why did I say that, a company would consider using debt capital instead of just using interest? I mentioned an advantage where I said that the interest rate is deductible. Therefore, here, when we are calculating the cost of debt, we also need to consider this tax, the tax deductible amount. And, because it is an advantage for the organization, so therefore the cost will probably reduce, right? So therefore, the KDI divided by MV is the irredeemable debt calculation before considering taxation. So the the formula which is generally used, pre-tax cost of debt, the post-tax cost of debt includes the tax amount as well. So now let's see how this can be done. So what happens is the cost of debt that we calculate here using the KD that we calculate by dividing interest by market value of bond is multiplied by 1 minus T. T is the tax rate. So as you can see, KD 1 minus T equals I interest rate. Obviously, the interest rate payable has to be reduced according to the tax deductible amount. So 1 minus T is calculated, multiplied, and then divided by market value. So I was just kind of explaining to you how that is done. So these calculations will be doing in sections like investment analysis, but I just wanted to kind of explain to you how it is done. So now, when we are talking about the cost of redeemable debt, like the company will generally pay interest for a number of years, right? And then repay the principal at a premium or discount to the original loan. Okay. So hence, the market value of a redeemable debt is the sum of the present value of interest and the redemption date. So now, before we were talking about irredeemable debt, well, the amount of capital amount that was invested upon the company doesn't need to be repaid, but the organization need to repay. I mean, let's say the person who pays us the loan pays us like 10,000 pounds. I mean, if we just repay 10,000 pounds, do you think in a future date, do you think it considers inflation and the time factor and things such as that? No. So therefore, when it comes to redeemable debt, the company needs to consider all those factors and how the company has to repay the capital amount. Therefore, the present value of the interest and redemption payment is generally calculated in order to see how much we need to pay. So market value of a redeemable debt is the sum of the present value of the interest and the redemption payment, not just interest, it's interest plus redemption payments. So cost of capital is the internal rate of return, which equalizes the discounted cash flow receipts from the current market price. Now, IRR or interest rate of return will be a particular section that we will be doing later on, where I will be kind of explaining it to you more further on this concept. I'll be just skimming through this just for you to understand how this kind of works. But let me tell you what discounted future cash flow receipt means. So what is discounted cash flow? This is basically the cash flow that is supposed to be received in a future year. Is kind of discounted to identify the present value of that particular amount. So when it comes, let's say you have 100,000 that is to be received in year one, that is kind of multiplied by the discounted factor based on the cost of capital amount, which could be 10% or 20%. So that will be used in order to identify the discounted future cash flow receipts. So this actually, I will actually be explaining this to you more on when I am moving on with discounted, the section where we talk about discounted future cash flows, such as methods such as the NPV, and we'll be talking properly about IRR and then trying to see how IRR is properly calculated in the next section of this particular lesson. But I don't think I'll be able to finish all those today. So we'll probably be doing all those in our next session. So let me move on with it. So as I said, the IRR can be calculated according, there is a IRR formula. As you can see, A plus B minus 1 multiplied by A divided by A minus B, where A is big. Simple A would be the lower discounting factor. It is added by the difference between the lower discounting factor and the higher discounting factor. So difference between the higher and the lower would be added to the lower discounting factor and multiplied by a positive NPV, which you get from capital A, and then you divide it by A minus B, which is a positive NPV reduced by a negative NPV. So generally, after calculating the IRR, if tax is also adjusted, KD or the cost of debt for IRR would be IRR multiplied by 1 minus tax rate. The way we always talk, we did consider the tax deductible amount. We will consider IRR multiplied by 1 minus T, which is the tax rate. So if the tax rate is, let's say, 40%, it would be 1 minus 0.4. So let's say the IRR is 10. So 10 multiplied by 1 minus 0.4 would be 0.6. So that multiplied by the IRR 10%. So it would be 6% after tax. I just did a small calculation. So when so IRR, what can IRR be used for? So one option is to calculate the real rate of returns. So real rate of returns, because IRR kind of considers two types of cost of debt. Considers the real discounted cash flows and calculates two NPVs. You will understand that later on when I explain to you the whole calculation under IRR, where you will calculate two and then the real amount will be calculated. So as you can see, according to IRR, if the IRR is 10%, let's say year 0 is £10,000. In year 1, with a 10% IRR, internal rate of return, the year 1 cash, the cash flow would be £11,000. Now, moving on to option 2. Option 2 says that that IRR can be used to calculate the rate at which NPV is 0. So basically, when we are doing the calculation, this is what we will be talking about, where we will use to figure out where the NPV is 0. So if we look at the option 2, investment needs to be equal to the present value of future cash flow. So the present value of future cash flow here is 11,000 into 1 divided by 1 plus 0, 1, which is 1 plus 0, 1 means the IRR rate. So then, therefore, the investment equals investment amount, which is 10,000, equals to the present value of future cash flow. So if that the IRR is the rate at which the NPV becomes 0. So as you can see, the investment is 10,000 and the present value of future cash flows is also 10,000. That means there is no net present value. However, now you will try to wonder what this is exactly. Okay, I just want you to kind of go through this. However, when we move on with the calculation of NPV and IRR, we will kind of move on and try to understand this section as well, and then, you know, refresh ourselves and to try and understand why we spoke about something like this here. Thereafter, now we were actually talking about sources of finance. So I was talking about debt, capital, different methods of debt. And now we are moving on to preference shares. So basically, what are preference shares? These are kind of like shares which give the shareholder kind of like a fixed dividend, but usually they don't have this voting rights at a company meeting. So difference between the preference share and an ordinary share is that ordinary share gets that voting right to decide upon the company's, you know, future action. However, when it comes to preference shares, instead of voting on it, they get a fixed dividend. So therefore, you as you can see, it's kind of like a source of finance which is more towards debt than towards equity. So they are categorized as equity or debt based on the underlying feature of the share. So when it comes to shares, I explained to you there are so many conditions that are attached. So based on what is attached there, the company will decide whether it's an equity or whether it's a debt. So if the share tends to give a predetermined maturity date and a dividend rate, it is then more suitable to classify as a debt. So as you can see, we were saying now what are the reason that we call certain loans as debt, because there is a predetermined maturity date, obviously, and a particular interest rate. So here the difference is if there is like a predetermined maturity rate as well as a dividend rate. The difference is the name, which says dividend rate instead of interest rate. Therefore, in this situation, it will be classified as a debt. So when it comes to preference shares, these are usually irredeemable. It is not a redeemable kind of thing. And the cost of irredeemable preference shares is generally calculated how? Dividend per share is divided by the market price. However, there are redeemable preference shares as well. So if it's a preference share which is redeemable, the cost of shares is calculated using the IRR method, but the tax adjustment will not be required as dividend is not tax deductible. So as you can see, if the preference shares are redeemable, then obviously the IRR will be considered here. So another thing that we need to remember is because preference shares, it's a preference shares and the payment is dividend, it's a dividend rate and not an interest rate. Do we consider the tax adjustment? No, we don't consider the tax adjustment here. So thereafter, we'll be also talking about bank debt, bank debt or non-tradable debt. This is something that we all know about. So bank and other non-tradable debt does not have a market value if they are not tradable securities, and market values are applicable to these type of debt. So, sorry. So when it comes to the debt, the average interest rate into a 1 minus T or tax, the rate will be used to identify the cost of debt. And as you know, bank we need to pay an interest rate, therefore the tax amount is deductible and it will be considered when calculating the tax cost of debt. Thereafter, we will move on to long-term finance lease. So now what is long-term finance lease, you would wonder. So long-term finance lease is like where the lessor or the financial company provides money to purchase a particular asset. So lessee has to settle the principal amount and a predetermined interest annual. So that is a long-term finance lease. And we will move on to venture capital. So what is a venture capital? This investors generally provide risk-bearing capital. And usually this is in form of like a participation in equity to company with a high growth potential. And the venture capitalists generally provide like a startup or late stage growth finance, usually to smaller firms, because it's very difficult for smaller firms. The sources of finances actually for the smaller firms are quite less. Therefore, venture capitalists use this opportunity and they give loans for smaller firms. Now we will be talking about grants. Now, what is a grant, you would wonder? So grant is basically kind of like an award which is usually given by like one entity, which can be a company, a foundation, or even like government, to an individual or a company in order to facilitate a specific goal or incentivize performance. So this depends on what is the need is. So a grant is like a gift to an individual or company that does not need to be paid back. So grants are never paid back. It is just provided for that. So it could be kind of like research money, it could be educational loans, it could be even stock options, or are kind of like examples of grants. So now companies generally provide stock options as a way to hold on. So the companies generally provide grants like in a way to provide for favorable, to provide incentivize the performance of any person who gets the grant. And qualified stock options grants are eligible for favorable tax treatment as well. That's one of the reasons that the company would decide on giving stock options as a grant. But when it comes to these stock options or the grants, it generally cannot be passed to others unless it's a will or a trust. So it's not something that is traded. So non-qualified tax option grants can often be passed to children or charities are taxed at a time of purchase, depending on the specific price of the grant and the market value of the stock being granted. Okay, so now we spoke about grants, and now we are going to kind of move on towards hire purchase. Now, what is a hire purchase? This is basically like a type of a leasing, where an asset of finance that allows firms or individual to kind of possess and control an asset during an agreed time, while paying rent or installment, covering the depreciation of the asset and the interest to cover capital costs. So what happens with a hire purchase is that the company generally, buys a particular type of a machinery. However, the person who buys it does not own that hire purchased machinery. They keep on paying back the rent or the installment as kind of like a depreciation. So when everything is over, all the payments are over, that is when the person who bought it will own that particular machinery. That's how the hire purchase kind of works. So basically, when you look at the hire purchase, it's like a financial solution which is suitable for businesses wishing to purchase assets without paying full value immediately, because the customer pays an initial deposit with the remainder of the balance, which is kind of paid over a period of time. On completion, the ownership will transfer. However, the company, the customer, the person is able to kind of use that machine. So even though they do not pay for the whole machine at that time. So a company without much finances can go for something like this. And the use of hire purchase or leasing is particularly common in like industries where kind of expensive machinery is kind of required. So basically, when it comes to construction, manufacturing, when there is kind of plant hire, printing, or even like road freight and transport, engineering, and different kind of professional services, hire purchase is kind of used, because for all these loads of machinery that is required. So it will be very difficult for like a company to invest only on machinery. So therefore, like they could kind of divide the amount, the cash that they have, and pay a small amount and use the machinery and earn their profit and repay for the machinery. So when it comes to the hire purchase cost, there are two things that we need to understand or kind of think about. One is the interest rate charged for financing. That is something that needs to be considered. So generally, rates are favorable to assets with high value. That is, let's say, machinery, agricultural equipment, as such, and assets that are considered soft due to low resale value, like printers, vending machines, office furniture, will be given less favorable rate when it comes to interest rate. So fees charged by the financing company for loan processing and administrative work meeting conditions. For example, if like a car is purchased on hire purchase, they may need servicing at a regular interval from a pre-approved workshop. So those need to be considered as the cost of hire purchase. So moving on, now we were talking about different sources of finance, and we tried to understand the cost of the different finances so that the company can decide upon which section to, which type of finance can be used and what kind of mix can be used to properly, in order to properly utilize the financing, the capital. Because also it's very important to figure out the source of finance in order to ensure that the company doesn't have a higher gearing. So the company needs to figure out which one is a short-term finance, which one is a long-term finance, which one is equity. So company will be able to decide upon the most suitable mix of finance when it comes to the company. So moving on, we will just do a small introduction of cost of capital here. So what is cost of capital? Basically, this is like a return an investor would expect from an investment from capital gains, such as investment include all sorts of capital, equity shares, common stock, preference stock, bond, and any other long-term debts. So cost of capital from an investor perspective, what the investor expect. But why do we call it cost of capital? Well, how come the name is considered as cost of capital? So basically, we call it cost of capital looking at a company perspective. Now, investor gets a return. If investor gets a return, that means the company has to pay, right? So when we look from a company perspective, what is it? Is it a return or a cost for the company? It would be a cost for the company. Therefore, the expectation of the return expected from the investor is actually a cost for the company. Therefore, that is called as cost of capital. So a return any investor would look for when making an investment includes the following thing. So return that is expected, which would be a cost of capital, will, from an investor perspective, these are the three things that they will look for. So one of the things that an investor will look for would be the return for the risk. So the portion of return the investor look for from risk he has undertaken by investing in capital. The person would always look for, okay, how much interest do I get for the whole risk that I incur? That is the return for the risk. Return for inflation, what is that? So now, when a investor invests in a company, it would be for more than 1 year. It could be 3 years, 4 years, 5 years. But within that period of time, there is a factor which is inflation. So if there is inflation, the money value will go down. Therefore, the return for inflation will also be expected by the investor. And so therefore, investor need to be compensated for the time value of money. We will be talking about time value of money. When we were talking about IRR, I explained to you, I will be talking more toward discounting and how it works. So basically, that is what time value of money is, and we will be doing more towards it later on, probably during the next class. And then we will also look for return for patience. Now, what is the return for patience. Like preference for holding cash in hand includes a person needs to spend for its transactions, right? You know, when you have money and you want to buy something, you can obviously use it and buy something. However, if you invest in another place, okay, let's say you invest in an organization, do you have the money in your hand? No. Therefore, it's difficult if you won't have that cash in hand to just buy anything that you want at that point of time, even though you have invested on it and we are supposed to get that particular money back. Therefore, when it comes to an investor, there's a patience involved as well, because okay, they have to have the patience not to buy something even though they don't have the cash in their hand. So basically, return for patience, this is basically identified actually as the transaction motive. So when an investor forgoes this motive, he has to be benefited for his patience. So when it comes to cost of capital, it's very interesting. It's a cost for the company. But when it comes to the investor, there's so many things that, you know, investor kind of, you know, is deprived of. And no, you know, when it comes to the return, they expect some percentage in order to whatever that was foregone by them. Like it would be the return for the risk, it would be the return for the inflation due to the business operation, you know, kind of like the industry situation. Then obviously there's something called the return for patience, which is it is the transaction motive where investor forgoes the motive of buying something from the cash. So that is something we have to talk about when it comes to cost of capital. So when an organization's cost of capital is the overall or average cost of capital in which each category of capital is proportionately weighted. All capital sources are included in calculated the weighted average cost of capital. So when it comes to the cost of capital, one thing that we need to understand is there is something called the weighted average cost of capital. Here, I actually wanted to include all that, but then what I thought was like, you know, why kind of include unnecessary things and, you know, complicate what you're working towards, because it's not exactly included in your specific learning outcomes. But I just need to, you know, because we're talking about cost of capital and, you know, an area that really requires you to understand investors' motive and understand how the investments work. I want you to understand. So one of the reasons that we all talked about these different sources of finance and why we need this finance is because, as I told you, there is a cost of capital for the company from investing in a debt finance and the organ. Then when it comes to the cost of the cost of capital, it would be an amount which has an average between a lot of things involved. So like if it comes now, when it comes to the cost of capital, you will wonder, okay, right, okay, when it comes to the company, okay, equity, right, you can calculate based on the rate. But when it comes to the debt, if an organization has, you know, has a lot of different types of, includes a different, you know, different types of debt sources, then obviously the cost of each source will be different. So how do you know how much cost that the company has? So basically what happens here in weighted average cost of capital is, this will obviously be covered in investment analysis. What happens here would be that based on the percentage, the weightage, let's say the company takes about 100,000 from loans, and the loan would have a 15% interest that needs to be paid. And then the company has another debenture, which is 200,000, and the cost of capital or the rate is 15%. So now the loan is, did I say 10, 15? Okay, let's say the loan is 10%, the debenture is 15%, and then there is another one, let's say a Eurobond, which includes around 7-8 some payment, and then something like that. That's, let's say there's a mix of different debt. However, can you just, add in everything together and say, okay, 10%, 15% together and divided by 2. Okay, then it must be 12.5. Maybe the cost of capital is 25.5. No. If, let's say I took 100,000 loan, the 100,000 pounds of loan, and if I take 15,000 pounds of debenture, that means that weightage needs to be considered here. So from the 10%, only from the 10%, the amount which is suitable for the weightage of 100,000 need to be included. While the weightage, so what happens is, like 100,000 plus 150,000, I'm like, I didn't want to include this weighted average cost of capital because it's so complicated, because you will have like a formula and you will be doing it that way. But I want you to kind of simply understand the concept. So, okay, right, the loan is 100,000 and the debenture amount is 150,000. So when we take the weighted cost, how do you think it would be? Can I just add 100, 150 and I say, okay, 250,000? No. And then do it? No. So what happens is, from 250,000, 100,000 divided by 250,000 into the 10% would be the weighted amount for the loan. And from the 150,000 divided by 250 multiplied by probably like the 15% would be the amount for what did I say, debentures, right? Sorry. So debentures. So that there will be kind of like a calculation on the weightage. The proper weightage will be considered for the cost of capital, and then the cost of capital will be kind of like calculated. They will be added upon and averaged, and those will be averaged, and this average amount will be used as the cost of capital for the company. I just hope I didn't confuse you too much. I just want you all to understand that the cost of capital is basically the average of between the proportionately weighted different types of debt capital amounts. Okay, so that's why you call it weighted average cost of capital. So moving on, we have to talk about evaluating strategic investment opportunities. Actually, so now today, I don't think I'll be talking about this, because this is a section which is very important and includes all the calculations I'll be talking about, because this talks about investing, how the strategic investment happens and how the calculations happens, and then how does a management choose on the most suited investment opportunity. So, I'm not going to talk about this, but I want to show you this particular chart, the graph, the chart, for you to understand what we will be covering next week, because we will be talking about how the financial evaluation happens where we will be talking about non-discounted cash flow methods like payback, ARR, and then we'll be talking about discounted cash flow methods. So we'll be obviously trying to figure out what discounted cash flow techniques are, and then the payback, then NPV, IRR, those will be considered. So I said that we will be properly covering IRR during next week, and that will probably happen in the next class, as I explained to you. And another way of financial evaluation that we will be talking about would be the non-financial evaluation using the suitability, feasibility, and acceptability framework. So that is what we'll be talking about next week. And I hope that you understood actually what I talked about today. And I hope that you have a good day. Okay, goodbye, everyone. See you next week. Bye.